Stop trading engulfing candles as if they are a buy or sell button. Most traders do not lose with engulfing because the pattern is useless. They lose because the moment they see one big green candle or one big red candle, they treat it like the market just gave them permission to enter. A big bullish candle appears, they buy. A big bearish candle appears, they sell. Sometimes they even enter before the candle closes because they are afraid the move will leave without them. But that is not trading price action. That is reacting to a candle. An engulfing candle is not a setup by itself. It is only one piece of evidence. And evidence only matters when it appears in the right place, after the right battle, with enough space for price to actually move. So in this video, I want to change the way you look at engulfing completely, not as a pattern to memorize, not as a shortcut, not as a magic reversal signal, but as a clue that tells you something about the fight between buyers and sellers. By the end, you will know which engulfing candles are worth your attention, which ones you should ignore, and how to read them using naked price action, location, supply and demand, bull and bear control, structure, invalidation, and risk to reward. Because the goal is not to trade more engulfing candles, the goal is to filter better ones. First, let us define it quickly. A bullish engulfing candle happens when the previous candle is bearish, and the next candle is bullish, with the body of the bullish candle covering the body of the previous candle. A bearish engulfing candle is the opposite. The previous candle is bullish, and the next candle is bearish, with the bearish body covering the previous candle's body. That is the textbook definition. But here is the problem. The definition only tells you the shape. It does not tell you whether the trade is good. A candle can look perfect and still appear in a terrible location. It can be large and still have poor risk to reward. It can engulf the previous candle and still be trapped inside a messy range. So recognizing the pattern is the easy part. Trading it well is a different skill. A correct-looking engulfing candle is not automatically a quality setup. What we care about is not just, did this candle engulf the previous candle? We care about 5 deeper questions. Where did it happen? Who was in control by the close? Did it trap one side of the market? Did it change structure or confirm direction? And is there still enough room for the trade to make sense? If those questions are not answered, the candle is just a candle. The first filter is location. Do not start with the question, is there an engulfing candle? Start with the question, where is price? This one change will remove a huge number of bad trades. An engulfing candle near a strong demand zone means something different from an engulfing candle floating in the middle of a range. A bearish engulfing candle at fresh supply means something different from a bearish engulfing candle right above a support level. Price action only makes sense when you read it in context. Good locations include clear supply zones, clear demand zones, major support or resistance. Flip zones, where old resistance becomes support or old support becomes resistance, important highs and lows, and areas where price has not returned for a long time. Bad locations are usually the opposite: the middle of a range, a messy sideways area, a zone that has been tested too many times, or a place where price immediately runs into another obstacle. This is why many traders get confused. They find a beautiful bullish engulfing candle, but it appears directly under resistance. So they buy strength into a wall. Or they find a bearish engulfing candle, but it appears directly above demand, so they sell weakness into buyers. Then they blame the pattern. But the real issue was location. An engulfing candle in the wrong location is just a large candle. Before you think about entry, stop loss, or target, look left. Ask yourself, is this candle appearing at a place where buyers or sellers have a real reason to react? If the answer is no, ignore it. That is not hesitation. That is discipline. The second filter is the battle inside the candle. An engulfing candle is not important because it has a name. It is important because it can show a shift in control. For a bearish engulfing candle, the story is simple. Buyers tried to push price up. For a moment, it looked like bulls were winning. But then, sellers stepped in with enough pressure to push price back down and close strongly. If the candle closes near the low, that tells you sellers finished the candle in control. But if the candle leaves a long lower wick and closes near the middle, the message is not as clean. Sellers pushed, yes, but buyers fought back before the close. That is not the same quality. For a bullish engulfing candle, the logic is reversed. Sellers pushed price down first. Then buyers absorbed that selling pressure and drove price higher. If the candle closes near the high, buyers ended with control. But if there is a long upper wick, it means sellers were still defending. The candle may look bullish, but the close is not strong enough. This is why the close matters so much. The wick shows where price traveled, the body shows where the real battle was accepted, and the close shows who had control when the candle finished. A strong engulfing candle usually has a clear body, a decisive close near the extreme, and enough range compared to the candles around it. A weak engulfing candle often closes in the middle, has a large wick against the trade direction, or fails to break an important high or low. So do not just ask, is this candle green or red? Ask, who actually won the candle? Because price action is not about candle names, it is about control. The third filter is the trap. This is one of the most useful ways to read engulfing candles, because many strong moves begin after one side of the market gets caught on the wrong side. For a bearish setup, imagine price pushes above a previous high. Breakout buyers enter because they think the market is continuing higher. At the same time, stop losses from short sellers may be triggered above that high. For a moment, the breakout looks real. But then price fails to hold above the high. Sellers step in, price drops back below the level, and a bearish engulfing candle closes strongly down. Now ask yourself, who is trapped? The breakout buyers are trapped. The late buyers are under pressure. Anyone who bought the breakout now has to deal with price moving against them. That is why the engulfing candle matters. Not because it is red, but because it appears after a failed push higher. For a bullish setup, the same idea happens below a previous low. Price breaks below the low. Breakout sellers jump in. Stop losses from buyers may get triggered. Then price fails to stay below that level and closes back up with a bullish engulfing candle. Now the sellers who entered the breakdown are trapped. This does not mean every sweep becomes a reversal. Nothing works every time. But a sweep, followed by a strong engulfing candle at a good supply or demand zone, is much more meaningful than a random engulfing candle in the middle of nowhere. So do not only ask what color the candle is, ask who just got trapped. That question will improve your price action reading immediately. The fourth filter is structure and space. A good engulfing candle should not only look strong by itself, it should also do something useful on the chart. For a bearish engulfing candle, does it break a small range? Does it break the nearest short-term low? Does it create a clear displacement away from supply? Does it show that sellers are not only reacting but actually taking control? For a bullish engulfing candle, does it break a small range to the upside? Does it take out a short-term high? Does it move away from demand with strength? Does it create a higher low or shift the local structure? Engulfing shows force. Structure gives confirmation. This is especially important inside ranges. Many traders see an engulfing candle inside a sideways market and enter immediately. But inside a range, both sides can produce strong candles. One large candle does not mean the range is finished. If price is stuck in a messy area, wait for it to break out of the small structure first. Let the market show that one side is actually taking control. Also look to the left. If the same price area has been traded many times with lots of overlapping candles, the zone is noisy. There may be orders on both sides, and the reaction can be weak or messy. But if price returns to a clean level after a long time, or reacts at an extreme where there is open space to the left, the move can be cleaner. Less traffic on the left often means a cleaner reaction. More traffic on the left often means more noise. This is not a perfect rule, but it is a useful filter. A quality engulfing setup needs more than a candle. It needs location, control, structure, and room. Now let us talk about the part most traders care about: entry. There are 3 common ways to enter after an engulfing candle. The first way is entering after the candle closes. This is the most direct entry. It can work when the location is excellent, the candle is not too large, and the risk to reward still makes sense. But the danger is obvious. If the engulfing candle is huge, Your stop loss may be far away, and your entry may come after most of the easy movement has already happened. A beautiful candle can still give you an ugly entry. The second way is waiting for price to break the high or low of the engulfing candle. For a bullish engulfing candle, you wait for price to break above its high. For a bearish engulfing candle, you wait for price to break below its low. The benefit is that if price does not continue, you may avoid being triggered. The downside is that the entry can be even farther away, so risk to reward may become worse. The third way is waiting for a pullback. This could be a pullback into the middle of the engulfing candle, a retest of the broken level, a small supply or demand zone inside the move, or a cleaner price action reaction after the first push. This often gives a better entry and a tighter risk area. But there is a trade-off. Sometimes price will not pull back, and you will miss the trade. That is normal. Missing a trade is not the same as losing money. The more important question is not, which entry is always best? The real question is, which entry still gives me a logical stop loss and enough room to target? Your stop loss should not be placed where you feel comfortable losing less money. Your stop loss should be placed where the trade idea is wrong. For a bullish engulfing setup, that might be below the engulfing candle, below the demand zone, or below the swing low that created the reaction. For a bearish engulfing setup, that might be above the engulfing candle, above the supply zone, or above the swing high that created the rejection. Do not place the stop too tight just to make the risk to reward look better. That is not a better trade, that is just a weaker plan. Now look at the target. Do not enter first and then hope price travels far enough. Before entering, ask, where is the next opposing force? If you are buying, where is the next supply zone, previous high or resistance area? If you are selling, where is the next demand zone, previous low or support area? If that opposing level is too close, the trade may not be worth taking. This is why a huge engulfing candle can be tricky. It may be a strong signal of pressure, but if the stop is far and the target is close, the trade is poor. A good setup with bad risk to reward is still a bad trade. Your job is not to trade every good-looking candle. Your job is to find trades where the context, entry, invalidation, and target all make sense together. Another mistake traders make is assuming every engulfing candle is a reversal signal. It is not. An engulfing candle can signal reversal, but it can also signal continuation. A reversal engulfing candle usually appears at an important extreme, a supply zone, a demand zone, a major high, a major low, or after a liquidity sweep. It often shows exhaustion from one side and a strong response from the other side. For example, price sweeps below a previous low into demand. Sellers get aggressive. Then buyers absorb the selling and close strongly higher. That bullish engulfing candle may be evidence of reversal. A continuation engulfing candle is different. It often appears after a pullback inside an existing trend. Price pulls back into a demand area during an uptrend. Then a bullish engulfing candle appears and shows buyers defending the trend. Or price pulls back into supply during a downtrend. Then a bearish engulfing candle shows sellers stepping back in. In that case, the engulfing candle is not fighting the trend. It is confirming that the dominant side is still in control. So again, the candle itself is not enough. The meaning of an engulfing candle is not inside the candle. The meaning is in the context around it. Ask, is this candle rejecting an extreme, or is it continuing the current flow? That one question will stop you from forcing reversal trades in places where the market is simply continuing. Let us put this into 3 simple examples. Example 1. A beautiful engulfing candle you should ignore. Price is moving sideways. The chart is messy. There is no clear supply or demand zone. Then a big, bullish engulfing candle appears in the middle of the range. Many traders buy immediately because the candle looks strong. But look closer. Price is still inside the range. Resistance is nearby. There is no clean space to target. The stop would be wide and the reward is limited. That is not a good trade. That is just a strong candle in a bad location. The lesson: a pretty candle does not fix poor context. Example 2. Bearish engulfing at supply. Price rallies into a clear supply zone. The move upward starts to slow. Price pushes above a recent high, which attracts breakout buyers. Then the breakout fails. Sellers step in, and a bearish engulfing candle closes near the low. Now the story is different. The candle appears at supply. Buyers tried to continue higher and failed. Some buyers are now trapped. Sellers closed with control. If price then breaks a small local structure to the downside, the setup becomes much stronger. A sell idea may make sense only if the stop is above the invalidation point and the next demand zone is far enough away to give acceptable reward. Example 3. Bullish engulfing after a sweep below a low. Price drops into demand and pushes below a previous low. Breakout sellers enter. It looks like the market is breaking down, but price rejects the low, moves back above it, and closes with a bullish engulfing candle near the high. Now sellers who entered the breakdown may be trapped. But again, you do not buy just because the candle is green. You check whether the area is important. You check whether buyers closed with control. You check whether price can break a small structure or create a cleaner retest. You check whether your stop loss and target make sense. These 3 examples are enough to understand the main point. Engulfing is useful when it tells a clear story. No story, no trade. Before you trade another engulfing candle, run this checklist. First, where is price? Is it at supply, demand, support, resistance, a flip zone, or an important high or low? Or is it just floating in the middle of the chart? Second, did one side clearly win the candle? Look at the close. Look at the body. Look at the wick. Did buyers or sellers finish with control, or is the candle still uncertain? Third, did the candle trap anyone? Was there a sweep above a high or below a low? Did breakout traders get pulled in before price reversed? Fourth, did structure confirm? Did price break a small range, shift local structure, or create real displacement? Or is it still stuck inside the same mess? Fifth, where is the trade idea wrong? If you cannot point to the invalidation level, you do not have a trade idea. You only have a candle. Sixth, where is the next opposing level? If you are buying, where might sellers appear? If you are selling, where might buyers appear? And seventh, is the risk to reward still worth it? A beautiful engulfing candle with poor risk to reward is not a good trade. So stop asking only, is this an engulfing candle? Ask better questions. Where did it happen? Who won the battle? Who got trapped? Did structure confirm? Where is the idea wrong? And is there enough room for price to move? Engulfing is not a button. It is evidence. And good traders do not trade more engulfing candles. They filter them better.